Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Pederson.
Thank you for joining the Real Estate Risk Report. I'm your host, as always, Lance Pederson. So today we have two guests on the show. We usually have one, but today we've got a lively bunch. And as I refer to them as the Brain Trust, which they humbly told me that's not the case, but I know that is the case. Bob, Fraser, and Jim. There we go. Jim Maffuccio. There we go. Jim Maffuccio with Aspen Funds. So thanks for joining us, guys.
Great to be here.
Yeah, excited to do this episode. I always like having a couple guests on; makes it more interesting. So, and Aspen Funds also, my day job is over at Verivest, and these guys recently became members of the Verivest Sponsor Network. So we're excited to have them join us, and so I've been in the business a while, and I've known about these guys for a number of years, probably 6, 7, 8, 9 years. Been following them. So these guys have been in the business quite some time, and I'll have them sort of share their backgrounds with you. But they're really good at what they do, and we'll dig into kind of their strategy and how they do what they do. So, Bob, why don't you kind of kick us off? Why don't you share with us, how did you get into this business of real estate stuff, and what kind of led to the formation of Aspen Funds?
All right. Well, my background is not like most, I think. I mean, I was a computer programmer from UC Berkeley and actually worked as a programmer for many, many years, and loved that. Started a tech business in the late 90s that kind of blew up and ended up raising $44 million in venture capital, and we're just shy of an IPO when the market cratered. And so ended up getting completely wiped with that. But I got what I call a street MBA, and I say they're very, very good, but they're way more expensive, Yeah. So anyhow, really became a finance guy after that, and started a hedge fund and a few other things and really figured out I didn't like the public markets very much, and was looking for something very different when I met Jim, who was a real estate guy. And I just love the stability of real estate, and I love the predictability, the security of real estate after having two debacles in the public markets. I just realized I want something that's a lot less risky. And of course, the traditional thinking about risk is that the public markets are way less risky. I don't know where they get that stuff. It's like, how many drawdowns have there been of, 50% or more in the public REITs? And it's just insane, the level of risk people are taking for very little return. The returns are also far, far lower. So anyhow, we kind of joined forces. Jim's background is real estate. He had this really cool idea in notes, and my background is really knowing how to build businesses and how to do the kind of the quant stuff and the scale things and the capital side. And so we teamed up, and we've just had very, very steady growth for the last 8 years.
Yeah. So how about you, Jim? Yeah, because being the real estate guy, maybe share your sort of real estate journey.
Real estate guy. Yeah. Wow.
Yeah.
In the less risky area of real estate, right?
Or at least it's less volatile.
It really depends on where you play in that world. So, and believe me, I know the hard way. So I started off as a civil engineer and got a job in project engineering for a large corporation. Did that for about 6 years. Got a really strong background, though, in strategic thinking and project management. And in 1986, I resigned from that company, oil company, and got my real estate license and started doing all things residential real estate. So I've been self-employed as a real estate guy since 1986. That's a lot of years. I don't want to add it up. But mostly what I was involved in Southern California was residential development and really focused on smaller infill projects at the big developers. Back then, everybody was a big scale builder, and they would do 200, 300 home tracts at a time. So we were doing these little boutique projects. Great time when it's a great time, and when it's not, it's terrible. So went through two of the really debt-directed cycles, one being the savings and loan crisis, and that's probably predates you, Lance.
No, I know it. Yep.
You read about it. I know it. See this?
Yeah, I read about it. Yeah.
Yeah, but we bled from it.
Yeah. So I had the most successful failure, in history. I won a Gold Nugget Award for one of our developments, and ended up losing the last, handful of the lots and homes through foreclosure because the market just absolutely tanked back then. And then I shifted gears to affordable housing, which I thought that'd be super stable. But what does affordable mean in Southern California? It's really kind of a joke. It was back then because of interest rates. But anyway, learned my lesson again that depending on what's happening in the financial markets, and specifically the real estate debt, has everything to do with whether you're a successful developer when your projects take a long time to come to fruition. So I found myself, 55 years old, completely washed out, zero capital and zero development opportunities in 2010.
In other words, a good starting point.
A really good place to start. So there was my street MBA. Only I had to go back and take the remedial course once. It wasn't enough for me. So I'm a slow learner.
But anyway, we argue about whose crater is bigger,
Yeah. Yeah. So Bob didn't mention it. He's being humble, but he actually had, when he says he built a tech company, it was actually one of, I think it was the fastest growing tech company in the Midwest, and he won a Ernst & Young, Entrepreneur of the Year award. But that's great to put on the wall, but financially you can't buy groceries with that. So we both kind of had these great resumes and not a lot to show for it, and we decided, we're still young, let's get after this. So I discovered the world of distressed debt, non-performing loans, and I mean that world was big in 2010 because the institutions were hemorrhaging. We used to call it toxic assets, and one man's toxic trash is another man's treasure. So I started in very small because that's all I could do. And anyway, Bob and I, through a very, I'd say a divine appointment, ended up getting together and launched Aspen Funds and at the end of 2012 and came out of the ground in 2013. And we just built this company. We're a management company. We're a fund management company. We manage mortgage funds that we have a team of 26 employees now that we've scaled that up from the day when it was myself and my son in my basement, and then Bob out raising the first money, family and friends in 2013. So here we are. That's the Cliff Notes version.
Yeah, but I mean, it is interesting because, like you said, it's like you got burned that one time, which seemed like it was sort of the black swan, and then it happens again, and you realize, okay, I was on the wrong side of the table, right? Because when that happened to you, there was some lender on the other side, someone who owned, that paper, and someone who bought that paper got the good deal. They bought it at the bottom.
Yeah. It's a well-worn cliche by now in our space, but when you drive through the downtown of any city, you don't usually see rehabbers or flippers or even builders' names up on the tops of the buildings. It's usually banks, financial institutions. So, I decided it's okay to be in debt, but if you're going to be in debt, be the lender and not the borrower. So,
right.
So we're up to our ears in debt in the industry, that is.
So for you guys then being on that side, maybe talk us through, the acquisition side. I mean, I think everyone understands, okay, you're going to be a home builder. Okay, I got to go buy some dirt and some lots, and I'll go vertical. And I'm a multifamily guy. I'm going to go buy these buildings, or that stuff's. I mean, I think for many investors, that's what their lure is. They get it. It's just easy to get, but it does seem that it's the note business. It's harder for your average investor to kind of get their mind wrapped around, how in the world do you even do that? How do you generate these returns? It just seems that there's so many questions. So maybe share with us, when you had that aha and realized, I got to do this, what is step one? Who do you start calling banks, or how do you even figure out, what's for sale?
Right. So in real simple terms, I mean, almost every real estate transaction, the vast majority of them are still there's two components. There's the title deed to the property, and that determines who has possessory rights or owns the property. And then there's the mortgage, which is a deed of trust or a mortgage, which secures a loan that the person used to buy that property. Well, if the person can't perform on making their payments, just like your car, except we don't come tow away your house. Instead, we go through, there's a foreclosure process in every state by which you as the lender can secure your investment by the collateral, which is the property. So when we had, whenever we have, and we always have defaulted mortgages, but in the 2008 through 2009 timeframe, it was like I said, a hemorrhage of these. So banks were literally failing because they couldn't get bad debt off their balance sheets, as well as once they foreclose and they have all this REO, they're not in business to manage properties, and so regulators are shutting them down. So they have to get rid of non-performing assets. So I just saw the opportunity to go upstream from the rehabbers, upstream from the short sale guys, upstream from the bid at the foreclosure auction guys, and go before foreclosure and buy the paper from the lenders before they got to the point of foreclosure. And it really helped out. It was really created a win situation for the institutions. And so where we chose to stick the fork in, because it was really the absolutely sweetest in terms of returns, is non-performing second mortgages, typically behind a first performing mortgage. So these are ones where the homeowner continued to pay their first, but let the second go, thinking that they, wouldn't get in as much trouble or whatever. So we were buying these at the time for pennies on the dollar at a deep discount, and just figured out how to work them out with the homeowners. So in a sense, we're buying crummy paper and fixing it up. We're rehabbing paper and then creating performing paper, which we can sell to an income fund, which we now have an income side of our business too. We've been running that for several years. So to put it in housing terms, you have rental properties, and that's our performing notes, and then you have rehabbers, and that's when we buy the non-performing notes, and we have to rehab that paper. So that's the simplest view of it.
Yeah, and I think that's super helpful. So yeah, then when you translate that for a passive investor might be listening, you have that you have an investment vehicle that's that rehab vehicle that's sort of buying the distressed paper, getting it to the point where you can get it performing again, and then you might sell that performing paper to what. Usually those distressed vehicles are like a close-ended. They've got a definite, you take capital in and you work it out and then it winds down, whereas the income fund is open-ended where people can go in, and that thing is, because they're more performing loans, it's generating real-time income, and then they can actually get in and they've got some kind of redemption right to get out, right?
That's exactly what we have. So we have 4 closed-end funds operating right now, and one that are non-performing funds, non-performing loan funds, and then one income fund that's performing, and it is open-ended fund. So it's exactly what we have.
So that does create, Lance, a perfect vehicle for, in our world, whether it's our non-performing workout fund or whether it's our performing paper fund, it's a lot of work for us. It's not an active investment at all for us. It's a very active business, but the beauty of this is, for an investor that has some capital, that doesn't want to really get their hands dirty and call on banks and go find these hedge funds and build the relationships and deal with all the drama of defaults, et cetera, and licensing, they can invest in a mortgage fund, know that their money is spread across hundreds or thousands of loans that are geographically diverse, and honestly sit at the beach and watch their ACHs come in on their phone, watch their deposits come in digitally. So it's a pretty sweet model for everybody involved. It's a lot of work for us, but we love it.
We can get into that. I agree. I mean, it's definitely a great vehicle for the passive investor, but to dig in on what it takes because once, like you said, and that's what I'm pointing out, these things are out there, whether we're in like the 2008, 2009, where there was just tons of it, but there's always someone that's defaulting on their mortgages, right? That's so it's not like this, is super cyclical itself. There's always people that are in that kind of situation, right?
But the cool thing about it is it is really the opposite of cyclical, right? So when the times are really bad, this product is really good. And so it ends up being something that's counter-cyclical. That's the word I'm looking for. And so it's so easy to get into cyclical businesses. It's very difficult to get into counter-cyclical. So it's a great investment as something that is very uncorrelated, But, we have seen the market significantly shift just since we've been in the business. We're very, very small. We just raised $1.5 million from friends and family and got started. And, and it was very much a cowboy kind of landscape. We just found some notes, and Jim is smart enough to get some really good notes, and and we worked those things out and made great returns, and then did it again. Today, a lot of the small pools of notes are gone. They're very difficult to find. It's all gone to larger type pools. The regulations have gotten far more stringent. There's a lot of regulators that are out there kind of, stalking the prairie looking for victims, of people that are cutting corners. So that's, it's really not a business for, and the rules have gotten more complicated. The bars have gotten savvier about how to get out of their debt obligations. And so you really have to know what you're doing. You have to know there's 100 ways to lose money in buying a note. And so you have to know what those are. And so it's very much changed since we got into it.
Yeah, I think, and I have seen that too. I mean, for myself, there was that period of time there where the notion of an individual investor going and picking and choosing their own notes sort of was something a person could pull off, right? But yeah, those days, as you said, everyone kind of moved in, and it's one of those things now where, there's a bunch of ways you can get kind of stung. And I think that, what I've heard too is that, especially from an investor standpoint, is a lot of times they sort of, the fees that a vehicle like this are charging, they sort of go like, oh my gosh, that's like 2% acquisition fee, or whatever the fee is. They're sort of like, that seems like a lot of money, because for them, it's like they think that it's easy. Like, you just sit around and go buy paper and, you don't do anything, which I have to inform them. I'm like, no, it's not quite that simple, right? Like, so let's just run through that so that I think people can get a better sense of it. Because for you guys, as you said, it's more competitive, which is code for, you got to do a lot more diligence up front, even to decide and to find paper that you might be willing to buy, right? So, like, maybe walk us through, like, even what that looks like when stuff crosses your desk, how you guys even evaluate whether or not this stuff is worth buying, and what do you do? Pick and choose certain ones, or you got to take the whole lot, or how does that work?
Yeah, it's kind of all of the above. Not to evade the question, but because we're focused on the non-performing side, we're focused on second mortgages. There's a barrier of entry on the small side, as we've already touched upon. To get into this business right now as a mom and pop investor, I would not advise my best friend to do it, because of we're actually now licensed. We're under a national bank, so we piggyback on their licensing. Plus, we've got a lot of our own. The level of licensing you have to get in regulations and all of that, it's just not, the barrier of entry is high for small guys. On the other side, for large guys, we're dealing in relatively small dollar numbers and volumes compared to the Blackstones that are out, buying $2-3 billion pools of mortgages, which includes mostly first liens as well as commercial paper, student debt, and everything else. So we do pare it down, Lance, to we're focused on buying the seconds, and if we have to buy every single second that a deal has in it to make the deal happen, we'll do it. Even if we end up turning around and selling off some of that to smaller players in our space. And the reason for that is where the real gold is in our business is the buying opportunity. That's the limiting factor. We make incredible returns on our acquisition cost. And so there is no real bad price per se. We're making really good multiples, and there's just not that many people playing in our sandbox. So but we will buy a single loan. If we have a fund, call us and say, we got this 1 second, went non-performing. We have a very sophisticated due diligence model that's been building over the 10 years we've been doing this. And I don't know, we got probably 85 columns on a spreadsheet that for every single asset we're looking at.
So let me paint a picture here. So you got everything you'd normally do to buy real estate. Okay, when you're buying the note, you want to understand the real estate. Is there a property there? Right? Yeah. Or is it a vacant lot? Right? Has it got a roof?
Well, that never happens.
And I could show you some pictures of stuff, some of the stuff we bought that we kind of pass around as a hot potato. You bought that one, dude. It's a shanty, and it'll look like an outhouse.
Google Earth.
This thing. How much?
3 months ago, it had a house on it.
It was a fancy house, Jim. My asset manager yesterday has shown us a picture. Here's a satellite picture 3 years ago. Here's a satellite picture today. is gone. We don't know what happened to it.
Where's Waldo, right?
So you got everything you do with real estate. You got every issue that you could possibly have with real estate. We have. Okay, now you have to understand the debt. And so you got to understand statute of limitations, and which is different in all 50 states. Yep. You have to understand what tolls that. You have to understand loan acceleration. You've got to understand the note terms, and you've got to understand if this has been stripped. We're buying seconds. So is there been a past bankruptcy? And there's bankruptcies that you can get stripped without even being discharged. So you've got the note, and then in our case with seconds, now the third layer is you have to understand the senior mortgage. And you may be blind on the senior, so you may not know because of a bankruptcy. It's hidden, right? Because you can't report on anybody who's filed bankruptcy. And so we have to sleuth to figure out what the second is or the first is, because we're in second position. The first is everything, right? So kind of 3 layers of due diligence that we have to go through to buy these loans. And so it's really sorting through, it's dumpster diving, sorting through the muck to find the gold. But as Jim said, the margins are great. So now once we've got a loan, well, great, it's still worth no more than we paid for it, right? So now we got to fix it. And literally half of our organization today, we have about 26 employees. I think 14 are related to asset management. And so literally this is primarily bankers. These are people with 20 plus years of banking experience doing loss mitigation. Lawyers, I've got 3 lawyers that work for me on staff. And administrators who are bankruptcy experts, et cetera, who literally are going through and fixing these loans. I could show you some of the kind of the decision trees and the paths these loans went through, and they're like 13 stops, and over a course of 3 years. And our people, they're just freaking masters. They're chess masters of financial chess game, figuring out how to work these things out. And, for a guy like me who's just a normal finance guy, I'm just a, 4.0 Berkeley programmer. This is way over my head, You know what I mean? And these guys are smart. And so extremely complicated, but the value is there, if you're successful, and we're very successful.
And the other aspect of, when we say fix these loans or rehab these loans, obviously in our world, that means either create a payoff or create a performing loan now where the borrower's paying. Think about this. On the other side of that, there's a homeowner that had this larger debt hanging over them that they don't know when the hammer's going to drop. They know they can't sell their property because there's this big fat lien, there's this big tick hanging off of it, Yeah. And so when they hear from us, if they'll cooperate, 65 to 70% of the time they do, and they're actually able to stay in their home with a better payment plan and a reduced amount that they owe, and it's still very profitable for us. So we really care about the people on the other end of this thing, and we don't believe in win-lose business. We believe in win-win. In this case, it's win-win-win because the institutions, they can't hold this paper, don't know what to do with it, and the homeowners win and we win. So it's really it's a sweet thing, and that means that matters a lot to us, the culture of our company. So
yeah, and I think it is, and that's what's important is that because you'll hear, and this is the whole, everything. It's the broad brushstrokes that we often paint things with. Just the binary sort of thinking is that many people hear seconds in this business, and they're sort of like, dude,
we love that.
Yep.
Yeah, you know what I mean? And so
which creates an inefficient market. So we love it. There's no such thing as a bad loan. There's just a bad price.
Yeah, you guys hear it all the time, right? Like, and that's what investors they've been trained to be like, because I've got people calling me up, investors who are saying, Lance, I'm looking for a debt fund that has all first lien loans, 65% LTV. And I'm like,
we could put one together for them. What do they want on their money? 3%?
Exactly.
I could put that together for them. No.
I say you join the club. I think they have jackets.
Okay, I actually prefer to buy seconds. I would rather buy a second than a first. And let me walk you through this, okay? So when Jim first said defaulted loans, I'm like, okay, conversation's over. And then he said defaulted seconds, I'm like, okay, I'm running, And he said, give me 5 minutes and I'll show you the model. And I'm like, okay. And I about fell out of my chair when he walked me through the model. And I said, this is too good to be true. And that's when we did a beta test fund, and it wasn't too good to be true. But so let me just paint a picture. Okay, $300,000 house, $100,000 senior lien and a $100,000 second lien. Okay, let's say I could buy that senior lien and maybe it's a 4% loan, and I can buy it for a 0% discount. So I'm getting a 4% yield, and I'm paying $100,000 for $100,000 debt, and I'm getting a 4% yield. Okay, am I going to lose money? No way. Zero chance. But now I can buy the second, and maybe the second has got a 7% coupon. Okay, so I'm right away doubling my yield. And it's still got $100,000 in equity on top of it. Okay. Now, in the last financial crisis, prices crashed 35%. If it crashed 35%, I'm still fully covered. And not only that, I buy this $100,000 debt not for $100,000, but let's say I buy it for $60,000, which is typical for us.
Yeah.
So now I've got, and let's say I bought it for $50,000 just to do the math. I've got a 7% coupon, but I bought it at 50 cents. I've got a 14% yield on this.
Wow.
Okay. And is there any more risk? No, not if you actually do the math. And then add to this idea, what if that guy refinances? He decides to take both loans out, including my really bad 7%, high interest loan. He takes us both out and refinances us. Well, I get paid off, but I don't get paid off my cost. I get paid off what I'm owed, which is $100,000, and I bought it at 60. I make a $40,000 profit. So I make a 14% yield until I make a $40,000 profit, which is almost a double. Which is better? I'll take the seconds all day long, and I'm super happy that people hate seconds. It makes me super happy because it makes the market very inefficient.
Originating, that's it's the nuance, right? Originating seconds, on rehab is risky business. Buying seconds, right, at a discount, that's different, right? It's different, and that's why I say that's why we do this show, is to say, if you want to be an investor, you have to use your brain, you have to think. Yeah. And you have to ask questions, because every situation's different. So to think that everything is always the same or what you think it is, you're going to miss opportunity, right? And that's really what you guys are doing too, is saying, well, it's got the scarlet letter on it, so a bunch of people avoid it.
Exactly.
It is toxic waste to them, so they can't wait to get rid of it. And then you build a team of 14 people who woke up this morning who are just like ninjas at this
exactly.
stuff. Sleep it. That's called risk mitigation. Right,
exactly.
That's how you mitigate the risk.
Now, Lance, let me walk you through our underwriting for a performing note. Okay, so one of the things we do, and I'm kind of a math geek like you are. Okay, I'm just a nerd. I'm a total math nerd, and so one of the things we do when we buy a performing note, we lay it up on an analysis spreadsheet, and we do a discounted cash flow. It's called a discounted cash flow, which any finance guy knows. You basically look at the cash flows, anticipated cash flows of this note, and you come up with a present value, which is a mathematical value of that note at today's today. It's a mathematical value of future cash flows. Well, what we do is we actually come up with every possible outcome for this note, including default in year one, default in year two, first default if it's in second position in year one. We include every default scenario, every early payoff scenario, every full payoff scenario, every refinance scenario. Okay, we lay out every possible outcome. Okay, and we do a discounted cash flow for all of those. And then based on our experience, we weight those. We do a weighting of which one is more likely and what's the probabilities of those. And we assign a 30% probability to the default scenarios, which we've never come close to. Okay, 30% probability. That gives us a weighted net present value for that loan, which let's call that the intrinsic value. It's what that loan is mathematically worth, right? Yep. Mathematically worth. Just to give you a picture of how inefficient this market is, we have never paid that much for a loan, ever. Having, with 3 times the weighting of default, we still have never paid that much for a loan. These things are so darn discounted. And so all day long, I'm buying this stuff. We can do this an analyzer, and it's kind of a moot point at this point because we've never had to pay that much for a loan. We buy it at a significant discount to intrinsic value.
Yeah. And the thing that really adds value for us is, in addition to that, when loans do default, which isn't 30% of the time, it's actually less than 10 has been our experience. we actually are profitable with our defaulted loans. I think we're at about 130% recovery of capital on the loans that go into default. Now that's a lot of work. That's a lot of work. But again, remember, we have a team full of rehabbers. So it's like, hey, we got another broken one for you guys. Fix this one and get it reperforming, or foreclose and we have to take the collateral. But we actually make a profit on our loans when they, in our performing fund, when they go into default. We don't like that happens, and it is work. But the investors don't see that work. They just continue to see their checks coming in. So
that's right. So of the loans, we've had 21 loans since 2017 in this fund that have had defaults that didn't end up in reinstatements. And basically, we made a profit of $172,000. I'm looking at my spreadsheet here on those loans. A profit. Because we bought it at a discount. So we actually make more money if they don't pay us than if they do sometimes. So...
Yeah, isn't it? Yeah. It's like you said, it's like you don't want it to happen. Because I think this is where I come to, right, is that starting to think about the constraints of the business model, right? Because you've got capital constraints. There's more stuff to buy than you have money to buy it, right? And then you've got resources, the rehabbers, right? Like that. I mean, it seems to me like for you, that becomes as much of the resource. So when you get it performing, of course you'd rather it stay there, not because you could make more money, but because if it goes the other direction, a human's got to pick it up. And they got to start doing something to it, right? Like, and that's what I mean. The beauty of it is it's math, right? It's like that. It's all mathematical, right? And you can see it.
We figured all of that in. We priced all of that in. So
exactly.
But we still pricing it in is one thing, but you still have human beings to manage and offices to pay the lease on and insurance and everything else. But we love it. I mean, we built that.
Yeah, for us, it's an operating business. This is not a passive. This is not a passive business for us. For our investors, it's passive. But for us, this is a high work, high effort business.
Yeah, and that's why I like to have this discussion, because I think that sometimes, especially when it comes to note buying, there's sort of, I think it's misunderstood. I think that people think that it's sort of just, you go and find a package and you buy it and you sit back and it goes to the loan servicer or whatever. I don't know where it came from or why it's like that, but and I'm sitting there going, that's not how it works. I think there's so much heavy lifting involved to make this happen. And, and I think you guys have done a great job of articulating that, but that's...
Yeah, no, most of the servicers will do default servicing, but they'll also charge you a lot for it. And the outcomes are not, we actually went away from, we started that way, but we went away from it and built our own loss mitigation team in-house because we got far better outcomes. When you have really highly skilled people, ninjas, we have far better outcomes than we were getting from a servicer. So it is passive in one sense if you hire a servicer, but you may not get an outcome you like.
Well, that's just and that's what I mean. Is because of all this stuff. In order to get it, you bought it at a discount for all the reasons we've talked about, right? And that means to get it to where you can add value to it, you're going to have there's human beings that own these properties, that live in these properties, that whatever. You can't eliminate that. Right. And then all the people that are involved, you have to basically run interference, all that stuff to get it into a position. So it's just that to be successful, to your point, the guys at the servicing, they're going to get paid the same amount they get paid at the end of the day, whether or not it turns out well or not.
Exactly.
It's just, there's not great alignment there.
No.
So, and I think that to use the comp, it's like running your own property management company rather than hiring a third-party property manager. But these are the little subtle differences that you need to dig into as investors to understand how people do what they do, because the execution of the business plan and the business model is everything. Step one is you got to understand, right? Don't invest in stuff you don't understand, right? And you can see today, but you probably hit play on this episode, didn't understand what the hell we're talking about. Hopefully now you actually have a little bit better understanding what we're talking about. But you see the facts that the humans, it goes right back to who are the people that are doing it. And to me, it's everything. You have to dig into those who are executing the strategy, really understand how they do what they do, and then decide, do I want to put my money and have them manage my money? Yes or no? That's the decision.
That's so, Bob mentioned on the front end, talking about the risk difference between the big markets, the institutional investments, the Wall Street investments. And, the biggest risk there is the business models, for the most part, have been proven out because a lot of really smart people have underwritten those companies and brought them public. They're usually run by really competent people on the operations side, but the risk is the market volatility, which nobody has any control over. in our business, the business model can be great, but I'll tell you where the real risk is the operator and the sponsor, and people that don't know how to vet, the operator's experience, their integrity, their relationships with their third parties, finding the stress points. I think that's where people in the alternative space can lose money, is just looking at somebody. Everybody's got a great marketing. Everybody's got a great pitch deck, but some people can execute and some people not so well. So that's probably what sets us apart. Is we're really proud of the team we've built. And, again, Bob and I, as co-principals of this thing, we've both taken our lumps. We walk with a limp, and that's I always look for somebody, that walks with a little bit of a limp and a little bit of humility, that's learned the hard way. And that's a good place to start. You also have to have the technical skills. So
you do, yeah. That's right. I mean, there's lots of nice guys out there that you can have a drink with or a beer with or play around and golf with. But it's like, do they know what they're doing? And it's just that it's investing. So, and I agree. I mean, I say it all the time too. Never trust a leader without a limp. You're looking for people who have taken the beating and but have come out, more wise than they were, right? And they know what they're doing. There's a method to their madness, and I think that's what it comes down to. We have a conversation like this. If you take the time to ask questions, to seek to understand, and you've got enough intellectual horsepower to get your mind wrapped around it. If you don't, that's fine. We're not all world beater intellectuals who understand abstract things. Go invest in apartment buildings. I don't know. Go do something different. But for those of you who go like this, okay, this makes sense, and you can get your mind around the team. To me, that's what it is. It's operational due diligence, and then it's investment due diligence, right? And I don't like the fact that people think that they aren't capable of doing these things on their own, because we're all capable, and if we want the reward, in this case, what could be a double-digit return, right, annualized, if you want that, that's the work you have to put in. It's educating yourself. Right, it's building relationships with people, it's meeting people, and if you take those steps, you can put yourself in a position to build your nest egg and still do the things that you enjoy without having to go through the brain damage that you guys do to do that and start a whole new business out of it. You can take advantage of placing capital into people like yourselves that kind of do it for you.
Yeah, it does seem like our investment, advisors a lot of times kind of tell people, oh, you can't understand this. This is out of your realm, and so people
need us.
Don't have the confidence. Yeah, you need me, to do this, and it is disappointing, because you're absolutely right. I couldn't agree more that people, could, if they just take the effort. I mean, how much effort do people spend building their career, right? How much energy creating their skill sets and enhancing their skill sets, but how much time do people spend over their investments, doing the same thing, really understanding how to be a great investor, enhancing their investor skill set? People, really should spend more time educating themselves to be a great investor. There's no reason you can't be, and especially as you said, if you pick something that you like and you can get your head around, there's no reason you can't really understand that space.
I agree, and I know it sounds so crazy, but I mean, I'm told, because I do this now, right? And like, I took my own step. I'm like, I'm doing my own podcast, and we're going to talk about the hard things. And I've been told at least once a week that they're like, you're wasting your time. Investors are stupid, is basically what they're saying. And some people are literally saying that. Like, investors, they don't understand anything. They're idiots. So those who are the active people, because, see, in their minds, they eat, breathe, and sleep it. So they speak the lingo and they whatever. And I'm saying, but see, that's where you're wrong. Because it's the lingo and the way you carry yourself. You're intimidating people, right? And then you're not the way your posture is such where you're saying, let me help you understand, right? You're trying to sell them something. You're trying to get money from them. And then you're interpreting that as that they're dolts and they're idiots or something, right? And I'm going, you're the one who's missing the boat, man. Like, I think that, and now there are certain strategies, long, short, hedge fund strategies he's talked about. There's certain things that are really, really complicated and that you'll never, you'll probably... The time and effort you have to put into trying to get your mind wrapped around it, really understanding it, wouldn't be worth your while. So you might be just throwing money in there and going like, let it ride. That's also like a form of gambling. I mean, people, do you understand all the machinations of how you breed a horse and train a horse and all that stuff? I don't. Some people do, but most people, they're just like, let it ride. I like the name of that horse, right? Like, whatever. That's called gambling. This is investing. And I think it is the investment advisor community. No offense. I mean, they can add value. But, I mean, often the way I look at it is many of them I meet, they're great relationship people, but they're not really great investors. They're better relational people than they are even at understanding their own investments, right? So then when it comes to things like this, of course they're saying, danger, beware, don't do it, because if they get questions that they should have the answers to and they can't answer them, then they look like idiots. So
if you look at the investment advisor tests and qualifications of today, there's nothing about alternatives that they need to learn. And if you look at like the large investor space, they're 40 to 60% invested in alternatives. So this is like the Yale
Yale endowment
and all this.
Yeah.
And yet the small guy is less than 5% invested in alternatives. Why is that? Well, it's because of these investment advisors who literally are completely ignorant of what is out there and the advantages of these kind of investments, and that basically use fear to drive the investors away from alternatives that are really far superior in a lot of ways, as the institutions are well aware of.
Right. Yeah, that's right. And I think that's what we experienced this last summer or whatever or last fall with the whole GameStop thing and the Robinhood sort of revolution. What you're seeing is that there's sort of this revolt where people are saying, no, I can learn how to invest. Now, I know that there's people that knock it because, Robinhood's it looks like a casino. It's like a gambling app. But I think what you're seeing is that more and more people are realizing like, oh, crap, especially as we've made the switch, from everyone being pensioners to, this notion of, your own retirement account, IRAs, and like it's up to you to save for your future 401ks. Right. Well, you had a whole generation that's sort of like, oh, crap, this happened to us. And then they just entrusted their money with whoever the money manager was. And now they're going, I don't like these results. And then they're saying, oh, crap, I'm actually, it's my money. Like I'm in control of it. I'm the CEO of my money. I probably should learn how to do this stuff. And I do think that in the next that's my prediction, the next 5 to 10 years, this thing you already see it. It's exploding. People are realizing like, man, I've got to learn this stuff. So it's great for those in the alts. I'm not sure about the investment advisors if they ever figure it out, but
we talked at the beginning about Bob mentioned somebody that spends all this time in their career, like the hoops they'll jump through to get the next raise or the next promotion. And you look at what the incremental, financial status per stress that gives a person, and yet I'm convinced, and it'd be fun to run the numbers on this sometime, but if you took a young professional just starting out, like say with an engineering job at today's salary, and you showed them how to invest wisely, I would say by the time they're 10, 12 years into their career, their investment portfolio could be growing at a faster rate than the best raise structure they could ever be getting in that company. And at some point in time, and it's probably in the 15 to 20 year horizon, depending on how aggressive they are, their investments could actually take over and be comparable to, maybe not comparable to their whole salary, but it's like, man, you could step out of this thing and now you've learned about the investment world. And I think of the people that have stuffed their money in a 401k and let it do the ups and downs of the stock market to make 3% over their 30-year career. I have family members that are like this, and it's like, if you'd have just bought, something as simple as buy a rental house in the Midwest once per year, in 30 years, you're a multimillionaire on passive investments, and that's a non-risk, that's a no-brainer business model. But only the uber wealthy get this. And so, anyway, Bob and I are both pretty passionate about helping passive, not just with our funds, but helping passive investors get control of their financial future, because it's a big deal. It's really a big deal.
Yeah, I agree, Jim. I totally agree. And that's what makes it fun. It's like these things are there. Yeah, they can be, like I say, I get it. Like that's what it can be intimidating, right? Yeah. But it's things that are worth doing or worth pushing through. And the reward, like you said, and you see younger and younger and younger people that are getting, understanding this, and they can get into this sort of stuff. Right. It can change your life, and you don't have to be a slave to your job or whatever. You can create multiple income streams, and that's all on the table for many, many people. So, I'm passionate about it, and I enjoy doing it. I enjoy talking about it. And so anyway, what good stuff. I love this conversation. I feel like we did our job. We put the cookies on the bottom shelf as much as we can. So thank you guys for that. Where can they learn more about Aspen Funds, and where should they go, Bob?
Aspen, like the tree, funds, funds.us. So aspenfunds.us.
Very good. Aspenfunds.us. Thanks, Bob. Thanks, Jim. I appreciate the time. Have a good day.
Pleasure to be here with you.
You too.
All right. My pleasure. Thanks, guys.